In this video, we are going to discuss about India's 37 provisions, contingent liabilities, and contingent assets. So, what is there here? Provision means what? Contingent liability means what? Contingent asset means what? And where we will present in the financial statement of these related items. So, now we will discuss about this. First of all, you should know about the liability. Liability means what? Liability means is a liability is a present obligation. The obligation is arising from past events and it can be the legal obligation or it can be constructive obligation. So liability means it is a present obligation arising from past events and it can be a legal obligation or constructive obligation. Legal obligation means if you are enter any contract or legislation, then you have one obligation that is as per legally, or you are from past practice you are doing something or your commitment is there of the entity, that is constructive obligation. For example, for legal obligation, if you are entered the contract with the employees for every Diwali you are paying the bonus, that is the agreement. If you are not paid, then they have legal obligation. Or if you are constructive obligation means every year there is no agreement. Every year you are paying the amount. All employees assumes this year also will pay the amount, but you are not paying. This is constructive obligation. So for past practice you are paying and you are committed to payment, but this year not paid. This is obligation, and we need to see and settlement of obligation will result in outflow of resources. Now you need to settle this transaction, the legal obligation or constructive obligation, whatever the obligation you have, you need to solve. For solving you need to outflow of some resources. This is liability. So finally the liability means liability is a present obligation arising from past events. It can be a legal obligation or constructive obligations, and the settlement of obligation will result in outflow of resources. Next, now you want to know about the provision. Provision means what? Provision means is a liability, but here the amount will be uncertain amount or timing may be uncertain. That is, for example, you have present obligation arising from past events. So now you have present obligation and outflow of resources have the probability. Probability means that is more than 50% or more, and the amount can be estimated reliable. Then it should be a provision. Here you have the uncertainty on amount or uncertainty on amount. The outflow is compulsory is there, but whether the amount will come this month or next month, it may be uncertain. Next, now you need to recognize the provision. When provision shall be recognized as a liability in the financial statement, so provision will be recognized as liability in the financial statement. Or amount of provision, how much you need to provide, means it should be measured as use the different methods. You can use the best estimate of the methods. Or if you are have an obligation, you have to estimate the amount, the expenditure, how much to be incurred, that will be provided as a amount of provision. Now for the estimation of the expenditure, if there is many possible outcomes is there, then you need to calculate the expected value by using the probability of each outcome. So one method will be expected value method by using the probability of each outcome, and another method will be if there is only one possible outcome, then directly it can be considered such amount directly. Now we need to see the whether we have possible outcomes or one outcome. If it is a one outcome, we can use that directly. If it is possible many possible outcome, then we can calculate the expected value by using the probability. Now okay, if the expenditure is incurred after 1 year, then the provision should be recognized at present value by discounting the expenditure using the pre-tax discount rate. So we need to use the pre-tax discount rate for the purpose of discounting if the amount payable is after 1 year. The provision was started uncertainty in amount or uncertainty in timing. So the timing will be next year now. Now if that amount is paying next year, then you need to discount that amount and charge interest expenses, that is finance cost, on such provision to unwind the discount over the period in profit and loss account at the discounting rate. If there is a risk that actual outflow would be more than the expected present value of outflow, then you need to adjust that risk by adding the expected present value of outflow. For example, you assume some percentage, 10%, but the risk factor was increased. Now, from that expected present value of outflow, we need to add the risk adjustment factor. Then we need to create the provision amount. Now, what should be the entry for the provision creating? The entry will be profit and loss account debit to provision account, and whenever we are paying that the risk adjustment factor, finance cost account debit to provision account. So whatever the opening balance is there into discounting factor, we need to consider here as a finance cost. Next, provision should be reviewed at each reporting date, and we need to adjust to reflect the current best estimate. If there is no longer is required, then we should to revert that provision. So at the every reporting date we need to verify that amount, validate that amount. If the amount is not required, we need to revert the amount as actually we are posted the past entry. Now here, if an entity can avoid any expenditure by the future actions. So if you are assuming there is some future action, then there is no provision is required for such expenditure. For example, you are thinking for next year you are going to incur some losses. So future operating costs may be increasing, or inspection, ship inspection is are coming, or future operating losses you may incur. The type of expenditure which does not arrive from the past events, that type of amounts you cannot take as a provision. Now here, when we are creating the provision, we should see that onerous contract or restructuring. Onerous contract means what? Here it is a contract in which unavoidable cost of meeting the obligation which exceed the economic benefit to the received under it. So it is just a contract where in which unavoidable cost. So you are going to meet some unavoidable cost of the obligation which is exceeding the expected benefit to be received for doing this contract. Now, provision is recognized on onerous contract at the lower of loss of fulfilling the onerous contract. So, how much you are going to incur loss, or penalty for non-performance of the contract, that is existing from the contract. You are leaving that contract, how much you need to pay that penalty, that amount. So, whichever is lower. Now, that is onerous contract, or you are going for restructuring, then it is a plan to change the scope of business or manner of conducting the business. Then here restructuring means you are changing some manner, you are changing some scope of business. Example, discontinuing a line of business or closure of operation in an area, that is known as restructuring. Next, now for the provision for the restructuring cost is recognized when constructive obligation to restructuring arises. That is, entity has some detailed forward plan for execution of this restructuring. You have the detailed forward plan, and entity has raised a valid expectation for restructuring by announcing the plan. So you have raised the valid expectation for restructuring the announcing plan, then this consider as restructuring. Whatever the this cost, restructuring cost you are incurring, you may create the provision for that. So for provision we are seen onerous contract, we should make the provision. the amount will be loss of fulfilling the owner's contract or penalty for non-performance of contract or restructuring contract. Restructuring cost will be created as a provision only when the entity has a detailed forward plan and entity has raised a valid expectation. Now, amount of provision for restructuring cost includes only the direct expenditure arising from the restructuring. So, only we need to include restructuring direct expenditure, that is the staff termination or redundancy cost or compensation to customers or lease termination cost. This all of the cost will be direct related expenditure, but which is the expenditure indirect nature. We should not including the provision of restructuring cost. Indirect may be that relocation cost or refining cost for employees which are remain in the company or impairment of assets which is not considered for provision of amount of restructuring. These all are not considered while creating the provision. Now, another provision, reimbursement provision means if expenditure required to settle a obligation is expected to be reimbursed by other party or it has virtually certain. Here virtually certain means we have more than the 95% of choice, then that reimbursement will be received. So whenever we are paying some amount, the amount of payment will get from the our supplier. We have 95% virtually certainty, then whatever the reimbursement amount will be, you are going to get that reimbursement amount shall be recognized separate asset in the balance sheet, and the provision of expense and reimbursement income can be presented in the net of a profit and loss account, and reimbursement shall not exceed the provision of amount. So reimbursement amount you are going to receive, that will be shown in the asset side, and provision whatever the provision you are going to create and you are getting some amount means it is income, you can show as a net of. Next, if the reimbursement is not virtually certain, then you need to disclose that financial statement. These all are about the provision. Now we are completed two concepts, one is liability, another one is provision. Now what is meant by contingent liability? Now contingent liability means, here meaning of contingent liability, first of all, possible obligations arising from past events that will be confirmed only on occurrence or non-occurrence of uncertain future events. So here we have the obligation, that obligation is maybe, that is possible obligation which going to arise from the past event that will be confirmed only occurrence or non occurrence of uncertainty future event. So certain future events is happening, based on that you can get the confirmation, you will get the obligation or not. Or you have the present obligation arising from past event and the outflow of resource is not probable as of now, or amount cannot be estimated reliably, then it should be considered as contingent liability. Now amount, how much going to recognize for contingent liability? Contingent liability shall not be recognized, but it should be disclosed in the notes in the financial statement. So as a footnote in the financial statement you need to disclose, you cannot recognize any liability. However, if possibility of outflow is remote, that is if you have the negligible amount, then disclosure also is not required, that is contingent liability. Now contingent asset, what is meant by contingent asset? Contingent asset means the possible asset arising from past events that will be confirmed only on occurrence or non-occurrence of uncertain future events, same like as contingent liability, but here contingent asset will have are some possible asset, their possible obligation, here possible asset. Now recognition of contingent assets, when will be recognized means, if the inflow of resource that is virtually certain, same like as contingent liability, virtually certain means more than 95%, it is not more a contingent asset, it becomes an asset, so then we will recognize as a asset. Then if the inflow of resources is probable but not virtually certain, so if we have virtually certain means that is more than 95%, it is a asset. If we have just 50 or more percent, then it will be contingent asset but shall not be recognized. Just we should disclose in the footnote of financial statement. Or if the inflow of resources is not probable means you do not have the probability to get the asset that is less than 50%, then contingent assets shall neither be recognized nor to be recognized. This is contingent assets. So what we are discussed in India 37 provision: contingent liability, contingent asset. Contingent asset means possible asset which arising from past event that will be confirmed only on occurrence or non-occurrence of uncertain future events. Here for the recognition, if it is more than 95%, we can recognize as asset. If it is more than 50% or more, then it will be shown in the footnote. If it is less than 50%, we cannot show in anywhere. Whereas contingent liability means here the contingent liability we have the possible obligation. Then here the confirmation will get from the occurrence or non-occurrence of certain uncertain future events, or we have the possible obligation that are arising from past event, and here the outflow is not known or outflow is less than the 50%, then it will be shown as contingent liability disclosed in the financial statements notes to accounts. If it is less than 5 to 10%, 5 to 4%, any negligible amount, it cannot be shown. And lastly we are discussed about provisions. Now